Welcome back. Well, Agusto & Co. Limited released its banking industry report for 2023, which gives a comprehensive review of Nigeria's banking industry to get a sense of expectations. Now, joining me is Ayokele Olubumi, Head Financial Institutions Ratings, Agusto & Co. Great to have you on the show.
Good morning. Thank you for having me.
Good morning. So before we dive into the report now, see the National Union of Banks, Insurance and Financial Institutions employees. They're supposed to start a strike today, saying that the employees should not go to the banking and withdraw services at this time. How are you seeing all of this?
Okay, from what we've seen so far, compliance seems to be low. Right, but we also notice that a lot of banks are actually on high alert. Right, the environment is so tense, so most of them are dressed down, although are attending to customers. And if the situation deteriorates, we see them, some of them actually shutting down. But something that we need to also note is that with the advent of electronic banking, and most of us actually doing a transaction, consummating a transaction digitally, you notice that even when the banks are physically shut, the impact might not be that significant, right? Because you realize that you can actually consummate all your transactions from the comfort of your home, from your offices, right? Using your phone or using your laptop.
I know that, even when there's no strike action, sometimes we see the apps actually fail. So I don't know, maybe we might expect more failure, with this kind of action now.
But also, don't forget that most of them are actually in their offices. And what I also expect is that most banks will be anticipating an upsurge in the volume of transaction of those channels, right? So a lot of them will have actually even prepared for that particular scenario.
All right, looking at all of this, how do you see, it's going to be a warning strike, definitely, but how do you see this impacting, the banking industry and, customers at this time? Is it going to be really minimal, as you said?
I think it's going to be minimal, not only even the banking industry, even across the economy. Don't forget also that a lot of us have actually mastered the work from home culture. Most organizations also have an hybrid culture. So unfortunately, you can even say that in the banking now, everywhere might look as if you don't have people there. But it doesn't mean people are not actually working on it, right? Most of them from the comfort of their homes, right? They can actually even be transacting and even supporting their customers. So I think the impact is going to be minimal. Even if you check it if you even check it around the economy, right? One of my colleagues was saying that, he himself was not even sure there is a strike going on. You notice that there's even still traffic on the road. So I think the strike won't be that effective. I think the impact is going to be a bit minimal.
All right, we'll keep tracking here to gauge compliance today. But let's go into your report now. It shows that the banking industry loan book, that rose by about 27% in the 2022 financial year. Tell me what drove this and how have banks managed to navigate this growth?
Thank you. A lot of factors contributed to the growth that we saw in the loan book of the banking industry. First, you notice that as the challenges in the FX market increased last year, most companies, particularly the manufacturing company, focused on backward integration, trying to get imports that hitherto were imported out they try to see how they can actually get it within the country. And most banks stepped in and supported them. And that was also supported by the discounted the DCRR window, which allowed banks to avail long-term funding to businesses, right, at a subsidized interest rate. So the DCRR, coupled with the challenges in the FX market, supported backward integration. Also, remember also that last year, most from the fiscal side, there was a lot of support extended to the agriculture sector. And we realized that most banks were also lashing up onto it. Also notice that there are some agricultural firms that actually export some of their products. And as we introduced, the RT200 policy was introduced last year, right? Most banks were looking at ways in which they can even get FX for their own, independent of the CBN. So we also saw an upsurge in the agriculture sector, specifically it grew by 31%, right? And also the oil and gas, right? That talks to the impact of the devaluation. The devaluation bloated the banking industry loan book to an extent, right? So the loans to the oil and gas sector, particularly the upstream segment, right, grew significantly and supported the growth that we saw in the industry's loan book.
All right, let's look at some of the reforms now. What specific reforms implemented by the new administration? We've seen subsidy removal, exchange rate harmonization. Which ones are expected to provide growth opportunities for Nigerian banks?
Okay, let's even first, you're talking about the fiscal side, but let's even first go back a bit into the monetary side. Because what you've seen is that with the change in the CBN that we've actually seen a change in the way the monetary policy actually implemented. I'm talking specifically about the CRR implementation, right? You notice that what we've seen now is the CBN is reverting to the methodological implementation of the CRR. Before we had the discretionary CRR in which the CBN indiscriminately just debits the account of banks, right? So we've seen the CBN double down a bit on this, right? And that will increase liquidity for the banks. It will actually even help the banks to have more funds to actually even play with and even give out as loans. You mentioned removal of subsidy, and that is going to revolutionize the downstream segment of the industry, because with the removal of subsidy, what you've seen that the profitability of the downstream segment has actually improved. And also, we anticipate some mergers in that particular segment, right? Such that you see that the stronger, we now have a bit more stronger players in that particular space. Not only that, right? The removal of subsidy and even the harmonization of the foreign exchange market has also increased the working capital need in that particular segment, right? You notice the cost of even getting a tanker, right, of PNS has even doubled, right? If not tripled, right? So that has also increased the need in that particular segment, right? Then also generally in the economy, we see that because Nigeria is actually import dependent, and the amortization of the FX, which has resulted to a significant devaluation of the naira, we see that it has significantly increased the working capital need of businesses, and that provides lending opportunity for banks. Also, let's not forget the Electricity Act, because that Electricity Act now provides more leeway for those providing captive power, for more players to come into that particular segment. And a lot of banks are looking at that also, right? We've also seen some efforts to reform the solid mineral space, right? Although it's still early days, right? But if done properly, right, to even sanitize that particular segment, it can also provide lending opportunities for the banking industry.
All right, talking about the cash reserve ratio now, do you expect the MPC to reduce this going forward? What are your expectations there?
I think for now, right, what we are saying is that the banks are even still trying to even adjust to the current cash reserve ratio that we have currently. To answer my question specifically, I don't see the MPC increasing it, at least at this their next meeting. Although we can actually have the change going forward, but I don't think they will actually even touch it this time around. I suspect that they might actually want to tickle with the MPR policy and then the asymmetric corridor. But I don't expect them to try and even touch the CRR. Don't forget that recently we had the CRR for the merchant banking space reduced, right? So normally they'll be thinking of ways of reducing it. But the reality in the economy is that it's going to be difficult for you to reduce the CRR and also be fighting inflation.
Yeah, definitely going to be difficult, because I was going to ask you that definitely that will play into the inflation story at this point. But in which sectors are you anticipating new loan disbursements to flow, and what are the reasons for this distribution?
Okay, I think the manufacturing industry will still remain the host of the banks when it gets to lending, right? Because you know that the manufacturing sector is one of the largest sectors in the economy. Despite the challenges, right, there will still be disbursement to that particular sector. And like I mentioned earlier, the devaluation has significantly increased, right, the working capital need of the manufacturing firms, and we expect more disbursements to that particular sector. Also, what we are seeing in the downstream segments, we anticipate more lending in that particular space. Agriculture and businesses with potential to earn FX will also be a place where banks are focusing on, because a lot of banks are looking at ways in which they can actually increase their foreign currency deposits, which they can use to support their customers. So we expect banks to actually be looking at those particular sectors. Also, something that you will notice is that, look, the telecom space, right, remained a growth area for the Nigerian economy in general, and even the banking industry, right? And we see was actually one of the sectors with the largest growth in last year, and we also expect that to continue in the near term. Then the power sector will also be a toast for the banks. However, the banks we're looking at not only the disco, but we're looking at all those captive powers. What we've seen in the last 2 years is that most state governments also, they've been paying down on their bonds, right? So you realize that leverage ratio has reduced significantly. And with the increase in the amount that they are getting from the federal allocation, you see that they've actually even grown their revenue. And a lot of banks are looking at where they can actually structure some transaction in which they can even disburse more loans to the state government. Because a lot of state governments have infrastructure issues, a lot of things that they are dealing with that they need some funding for.
All right. What emerging risks do you see coming for the banking industry in Nigeria? And how do you think banks can respond to swiftly, mitigate these risks?
Yes, what we are seeing in the economy, the adverse impact of this economy, of these reforms that are ongoing, you will notice that they will accentuate credit risk in the banking industry. And a lot of banks have been stepping up their loan monitoring. Right, a lot of banks, they've activated most of the measures that they have in place to be able to curtail deterioration in the loan book. Then also, cyber risk is also very important. Right, we mentioned earlier that a lot of transactions can be consummated through the digital channels, right? And a lot of banks are actually watching that, because we also know that all these hackers are very active, right, in that particular space. And let's also not forget that there is also a correlation between fraud and even the state of the economy. When there's a decline, when there's a deterioration in the state of the economy, things like fraud, the incidence of fraud actually increase significantly. Then with the immigration wave that we are seeing now, right, the risk of attrition, right, in the staff numbers in most banks has increased significantly. And we've seen that a lot of banks have actually been responding, either by increasing the remuneration, some trying even working on their offering to their staff, some trying to even work on the culture, right? That one will also impact that part of the banking industry. Then we spoke earlier about inflation. The banking industry is not insulated, and we believe that will also affect the banking industry. And let's not also forget the devaluation. The devaluation will bloat the loan book, which will have implication on their capital position, but also it will affect the operating expenses of most banks.
Right. Well, definitely a lot to look out for, and hope the banks actually mitigate most of these risks swiftly. Thank you so much, Yokunle Olubunmi, Head Financial Institutions Ratings, Agusto & Co. Thank you.
Thank you for having me.